Hello and welcome to Kirkland Capital Group's video podcast. Today we have Chris Carsley, our CIO, and my name is Freeman. We're going to talk today about alternative investments. That's a pretty wide subject, and I can't think of anybody better to talk about it than our own CIO, Chris Carsley. Chris, why don't you tell me a little bit about your background and tell us why you have this deep experience with alternative investments?
Sure. Thank you, Brock. I guess we can go into a little bit of my background. I started a little over 25 years ago in traditional investments, managing high net worth corporate accounts, here in Seattle, which was just long stocks, long bonds, putting together select allocations that really met the guidelines and the requirements for each of those individual investors. I had an opportunity to move in and I think out of luck, I got tapped on the shoulder to join a great group, Paloma, to come in and work on their securities finance and trading desk, where I got introduced to a variety of different operational structures and eventually an arbitrage trading desk where we did a lot of event-driven trades, tax arbitrage trades, and everything else. And that was sort of my first introduction to the alternative universe from a job standpoint. Now, obviously, by that time I had done lots of reading and had already been working in a number of different aspects personally in the derivative space and through college. And by that time, by joining Paloma, I'd already had my CFA, which now the CFA is an amazing program, but didn't really at that time focus much on alternatives.
So let me stop you there for a moment. Can you define CFA for our folks that are listening that don't know what that is?
Yeah, the Chartered Financial Analyst Program. It's one of the more difficult tests, I think, out there, but it is a great swath of information, very large body of information for anyone who wants to go into investment management that's going to have an analytical background. You'll see back when I took it, you didn't see a lot of CFAs, but you're seeing now more and more CFAs throughout the investment management world, and it is becoming one of the core credentials for people to have in the investment management arena. From Paloma, after spending years and learning a ton about alternative investments, not only from a trading standpoint, but having the opportunity to dive into a number of the Paloma funds and see how things were built and help enhance the operational structures of lots of different hedge fund platforms that were embedded inside Paloma. I then came back out west and worked for Benchmark Plus, which is at that time was a little over a $2 billion fund of fund that invested in a number of different esoteric strategies that all would be considered alternative as well. I think one of the key things that was important for Benchmark was you really had to have a wide knowledge around the investment platform, but also the operational nature of how those funds were built. Because one thing you saw in alternatives, it wasn't always the trader that was driving the particular value. It was a network or an operational structure or some level of efficiency via network that allowed that fund to have, the ability to capture outsized returns. So, you saw that a lot as you were looking across hundreds and hundreds of funds at Benchmark. From there, my career dove into another alternative sector, which was more your startups, your seed, angel, and venture, where I worked in building some variety of different startup companies, direct investing into a number of startups, and some were technology based, some not. And that led me to actually build a small seed angel fund and help a number of other people think about building out various aspects of their venture fund that they wanted to run. And then I went on to help and work with a separate platform in managed futures trading. So I've really had this fortunate career that has allowed me to touch and really dive in deep on a number of different platforms across the alternative investment space.
The one question this leads to, and I think was going to be a common question out there, is what exactly are alternative investments? I think for most of our listeners, unless they've been in this kind of investment thing for a long time and doing their own research, if we talk about alternative, maybe the first thing they think of is alternative medicine or something like that. But in the investment world, how would you define for individuals who might be diving into this first time, what exactly are alternatives, or what are they not?
Yeah, well, it's funny you end in that statement. It's sometimes easier to explain what an alternative is not than what it is. When you're looking at alternatives, you're looking at a situation of where it's everything that's not just long stocks and long bonds. So it's broken down into two core tranches of the traditional investment world, which is what most of us hopefully have had exposure to and had the ability to educate ourselves and are currently investors, where I'm going to go buy a mutual fund or an ETF or an individual stock, or I'm going to buy a mutual fund or ETF that's going to give me bond exposure. If you're a little bit more advanced, maybe you have a platform where you're doing direct bond purchase, through a brokerage house. That's all your traditional side. And that's actually where a majority of the money in today's investment world still lands. I mean, you need to understand alternatives sound really fancy and they sound really cool, which they are. They're pretty exciting. You can really be exposed to a number of interesting trade theories, not all good, but at least interesting. But that's actually a very small portion of the entire investment dollars in the world. Most of it still is in the traditional space. Now, with that said, I'll give a quick overview of alternatives. I told you what it's not. Now, think of hedge funds, venture, real estate, infrastructure, timberland, buying art, anything that is not that traditional long stocks and bonds. Now, a large portion, and a lot of people say this, well, how alternative are some hedge funds that are in the long short space? Well, there again, there's some argument around, as long short, how alternative it is in today's world.
So I'm going to stop you right there for a moment. Sorry, what does long short mean?
Oh,
I mean,
sorry.
explain that for us as as an individual investor who didn't really grow up in that hedge fund world. What does long short mean?
Oh, long short is probably one of the most prolific strategies in hedge fund world, where I am going long a basket of stocks. And
that means you're waiting for it to go up. You're waiting for that rise. That's the long play, basically.
Yep, I'm basically I'm buying shares of Apple or whatever, Netflix, Amazon, whatever stock is your favorite, and I'm buying a basket of those because I think they're going to outperform on the upside. And on then where a hedge fund can come in, that there's restrictions for a lot of other managers. They can't go short. And we could have an entire section of talking about what shorting is. I won't go into too much detail of how it actually works, but basically it is, I'm selling the stock, hoping that it will go down. So I'm selling something I don't really own, hoping that it will go down and I'll buy it back at a cheaper price. So when I go short, I want the stock to perform poorly. And so a hedge fund manager in the long short space will buy stocks that they think are going to go up more than average, whatever their benchmark has to be. And I'm going to short stocks that I think are going to go down more. So it's very, very difficult to add, but they're trying to add value on both sides. So I want to add return on the short side. I want to add return on the long side. So yes, that's what a long short manager is. And there are a lot of different forms of that. So, you see that as an alternative. You see, like I said, venture funds, seed funds. Those are the individuals that will go out and they will collect investor dollars to go in and raise and then invest in a portfolio of startup companies at various stages. They may be early stage to where the company's just getting started to. They may invest, later stage where the company's really obtaining growth dollars. And like I said, then you've got companies that go out and own timberland and they put in contract the rights and collect fees based on the logging of that timber. There's farmland, people owning actual farmland and then obtaining a profit from the sale of that crop. There's all of any of those types of structures would fall into that alternative bucket. Now, one of the ones also that I've had some exposure to, and we've also obviously built one at Kirkland Capital Group, is the real estate investment space. And so, just like anything in infrastructure, real estate is considered an alternative investment, and you can go into where you're doing equity purchase in real estate, or you can go in and do debt. And there's a variety of structures, in different subsectors that people invest in within real estate just in itself. So those are really
you've
alternatives.
laid out quite a few different areas here. Do you mind talking a little bit about maybe your own portfolio, whether currently or over the past few years, how you've got allocated across perhaps your traditional versus alternatives, and in the alternative space, what are you allocating? And I'm not necessarily asking for individual funds, et cetera, but give us an idea about what areas of alternatives that you have you invested in yourself.
I run what they call a hub and smoke model. I have a core portfolio that would look fairly passive and basic, where it's mostly traditional, where I have a number of different investments in individual stocks and a variety of different indexes and mutual funds that build that sort of a core. And then the alternatives are either instruments that I viewed that will enhance the return of my portfolio, or they will be a diversification nature to my portfolio. So they'll be what they call counter-cyclical. So when the market's going up, they may not perform as well, but when the market falls, they tend to perform very well. So it's a nice offsetting piece to your portfolio. Or you are lucky and you find some investments that are a little bit of both. They de-risk your portfolio and they capture an outsized excess return on comparison to other peer investments. And so in the alternative space, just because of my background, I may have a larger allocation to alternatives than most, seeing as that's where a lot of my career has been. And I've got, boots on the ground to where I'm involved in a lot of direct projects that are in the startup world. So I have some different individual investments in, seed-based companies. I actually do some international investing in some startups. I also utilize other people's expertise. I find someone who runs a fund that really has the time and expertise that I don't have because I'm doing something else. And I want to go to them and say, great, I think you are in the right space. I think you're doing something interesting. And so there's a few funds that I invest in that are in the venture space, but they invest in secondaries. And really quickly, what that is they may not be directly involved with a startup that's coming out with their first private issue or something. They are going into a company that's been issued for a while, is already owned, and they're buying that and providing liquidity to an investor that wants to sell a piece of their existing position, knowing that there is some event or some opportunity that's going to see a growth in those shares or a relatively shorter duration that company might actually have an M&A transaction or go public. So that's some of the work that I do. And then obviously I have some exposure in managed futures. And in the real estate space, and I both, I have some equity exposure direct in real estate. And then through our fund, I have a fair amount of debt exposure. I'm a big proponent of what we're building. And so I've put a fair amount of skin in the game, and I think it's a great investment for what we're doing. So I have looked at, I know everyone's always asking me questions. I get a lot of questions on crypto. I do a lot of research on crypto. I haven't personally dove in on that, but there's some interesting white papers and some interesting research as more data is becoming available. So that's a space I'm looking at, but I haven't dove in yet.
What about crowdfunding? If we think about what's happened over the last few years with, it's almost like alternatives have become far more accessible in the last 10 or 15 years with Reg A or Regulation A, which is the new SEC regulations that allow a much broader public participation in startups and other fundraising ventures. And then that led to this crowdfunding. Do you see that as a legitimate place for people to place their portfolio as an alternative?
Yeah, I mean, let's give a definition. Crowdfunding is exactly what it is. It's a platform of where investors go to access an investment. Now, that investment usually has found itself to be of an alternative nature, because why would you go to a crowdfunding platform when you could just go to your discount broker and buy any stock or mutual fund or ETF? So it has been a platform to where alternatives have gathered, and you're seeing a number of different high quality portals. And I think that is here to stay. I think it is good for the investors, but I think it's also very good for a lot of different individual projects, companies, syndications, and funds as a way to access a wider swath of capital. It's in raising money. I always say this: it's not rifle work; it's shotgun work. And having the aggregation of investors, let's say for us, we need accredited investors. Having someone who can actually put those together, and then I can quickly go out and reach hundreds, if not thousands, of potential investors and have them review my materials. That's very beneficial. Hopefully, the portal that you're using has quality deal flow, and for the investors in the funds, they get access to a number of investors they would never have run into normally. So I'm a huge proponent of that platform, and I think that's here to stay. And you're also seeing, changing regulations has really opened up that platform, but you're also seeing there's a number of people that run all these regulatory bodies and are passing laws. You just recently saw a widening of what is the definition of an accredited investor. And for people who don't know what that is, the old rules were you, as an individual, you made $200,000 or more for the past 2 years. That's gross income. Or you have $1 million in assets, investable assets that's outside your primary home. They added another qualification to that, to where for some people who may not meet those monetary guidelines, they may have a level of knowledge that has been achieved through their industry and can be proven through a variety of different accreditations. There's a few securities related accreditations that and licenses that now will allow you to be deemed as an accredited investor as well. But that's still the biggest barrier for investors to access alternatives. There is this accredited investor barrier. So there are a few ways to get around that through different filings that allow non-accredited, but for the most part, there's still a barrier there for a majority, but it's getting better.
Yeah.
But it's good to see that regulators are making these changes.
Yeah, absolutely. Let's take a step back and let's imagine that if you were a investor who now has reached accreditation, either through the amount of money you have set aside, you've been saving for a while, or you simply just have a high income like many of our tech investor friends or our techie friends who are earning those high salaries. And you maybe had your 401k for a while, you have some investments aside from that, but mostly they're in the public market or the 60-40, the split between normal investments in the stock market and then some in bonds, et cetera. And now you're thinking, you know what, I need to really investigate this alternatives market. How would you approach that? It seems like when you talk about alternatives, it's so broad that it's difficult to know where do you even start as a person who is busy already with their career and family, et cetera. But hey, I definitely need to make sure that I'm making the right decisions around my investment portfolio. Maybe they don't entirely trust the wealth manager, or maybe it's time for them to look for a new one or look for one beginning with. But how do I think about that as a accredited investor who now wants to dive into this world of alternatives? How do I look at that? How do I approach that?
Very complicated question. There's a lot of steps. One, I always like to say, alternatives are not for everybody. And there could be a variety of reasons that they're not a fit for you. Some of it, as you mentioned, it could be, I just don't have the time. Or I don't have the resources or the network to obtain the education I need. But if you were like, hey, this is something I want to add to my portfolio, and the key aspect is, okay, think about your portfolio. Where are you currently at? And why do you think you need an alternative? What is missing from your current portfolio that you think an alternative might fix? And one of the things to think about alternatives, if you're looking to add alternatives to your portfolio, are you looking to capture an enhanced return, or are you looking to diversify, risk? That's the real two key aspects that you need to understand with alternatives. And so take a long, hard look at what you've built and why you think you need to change something. And can we identify the alternative that is going to fix that problem? Next is you will have to have a large time commitment of you need to either get out there and through the web or a variety of different resources via the internet, educate yourself. The other way you can do that is to join various organizations. There are alternative investment organizations out there that their primary focus is networking and education. One that I actually represent here in Seattle is the CAIA, the Chartered Alternative Investment Association. It's a great organization that their primary focus is education and networking. So perhaps join something like that, or go through the tests, or take the fundamental program that they have just to get a basic introduction to alternatives and expand your network so that you now have people who do this every single day that you can maybe ask questions. That would be one aspect that I would think of. And one thing that you'll naturally gravitate to in your research of going out and saying, hey, what's available in the alternative space is you'll find something that you enjoy, that you like. It's something that maybe fits an interest of yours, or maybe meshes with a background you already have. That will only help motivate you to understand. You'll come up the learning curve quicker, and to understand the risks and the benefits of that alternative investment that might fit into your portfolio. But it is it's a lot of a deep search in your existing investments. It's also it is going to take time. That is one of the problems with alternative investments, is it is a very large and sometimes confusing universe with a lot of individual players of all sizes, and you will have to take that time to do the research. And it is important to find, once you've identified, hey, this is what I want to add to my portfolio, and this is something I have interest in, I feel like I'm educated enough to make that decision, you then need to go onto the search of where you can really find a group that, or groups that you feel you can trust. Because you got to remember, it's not just the investment, it's the team that's going to be managing that investment for you. That's just as important. You need to make sure you can get the transparency, you can understand and go through their docs, and that you have a team that wants to take the time to make sure that you have all your questions answered. And there again, that's another time commitment. You're basically doing some pretty heavy due diligence, not only on the investment that you've taught yourself about, now you're doing your research on the team, and that you feel comfortable with that, because you're going to be on a journey. You're going to be on an adventure with that team, and they're going to have your money, and hopefully they're going to be doing exactly what's going to fit and fill that need that you needed in your portfolio. And that's really where alternatives come in. But don't be afraid when you go out and you do your research and you realize, hey, this is just really daunting, and I'm not, and I think my portfolio is meeting my objectives. Don't follow the bandwagon like a lot of people did in 2008 and feel like you just need to jump into the alternative world, and you're not really sure why your portfolio is doing that. A lot of people made some very big mistakes in 2008. They felt like, well, everyone else is doing it. They got into a lot of investments and they didn't understand the liquidity nature, what a gate was. If you don't know what a gate is, it's usually in the investment docs that says, well, in times of stress, if too many people ask for their money back, the fund can close itself and not actually honor anyone's redemptions in a time of stress. That hit a lot of people who didn't read their documents and didn't really understand what they were getting into. So don't ever feel bad that if your portfolio is all long stocks and bonds and it's meeting all your objectives and you sleep well at night, and you've done your due diligence and you've dove into alternatives and you just found it's not for you, then that's okay.
But on the other hand, Chris, there's still a tremendous amount of danger in the public markets as well, as we saw in '08 when things crashed. Uh, you're still running a large risk, even though it sometimes feels, because there's so much talk about it, there's so much information out there. It's so easy to sort of just give your money over to an ETF or whatever, or in your 401k, pick a few things at the beginning and forget about it, that you don't even realize the danger of volatility that you've got, or the danger of things falling off a cliff with a certain company or fund that might explode in that area as well, right?
Oh yeah, no, there's definitely, if you're investing, you are taking a cadre of different risks, and understanding what those risks are inherent into what you've invested in is important. And that applies to traditional investments as well. The only reason alternatives are a little bit trickier is you don't have 50 websites trying to tell you what to do. You don't have 100 different brokers offering you information. That's really what I mean. But you are totally correct. I mean, just even investing in the S&P 500, which most people feel is a core benchmark of your equity investing, and like myself and most everyone else is probably listening to this, probably has some level of exposure to it. Um, it's pretty volatile. It moves around, and if you have the more volatile an investment is, and you have shorter time horizons, you really need to be careful about how much you're allocating to that investment. Because if you run into where you have a liquidity need in an emergency or something of that nature, and the stock market takes a really big hit and you have to sell, you will realize a loss. The one thing with equity investing, like into an ETF that does the S&P 500, well, it might go down 18%, but it doesn't. You haven't recognized that loss until you sell it. But if you have an emergency need and you need to recognize that, then you've actually materialized that risk for yourself, and it's now hit you directly in a monetary way. So you're right. I mean, there's risks and everything, and that's one of those things that for some people out there, they're trying to look at their portfolio and say, well, instead of just going to cash, is there other alternatives out there that might mitigate risk and not be correlated with what I already own? And correlation is there again, that moves in a counter-cyclical way. It basically, if the stock market's going down heavily, you have something in your portfolio that's hopefully stable, or showing a positive return.
Yeah.
And sometimes those are difficult to identify, but they are out there. Well, one of the things that we can deal with here is that's going on in today's world, why people are starting to look at more alternatives. I think everyone's happy with the equity market. Back-to-back double-digit returns on S&P 500. Most people have done fairly well on the equity side, but interest rates are low. They hit 150-year lows at the beginning of this year. And now people are really looking at the fixed income portion, or what that portion of the portfolio that's supposed to create lower volatility. And they're realizing it still creates lower volatility, but it doesn't provide any material return. And that's where a lot of people are looking to alternatives to see if it's something that will work for their portfolio, as they're trying to find an alternative that may have a similar risk profile, but is capturing a larger return that's going to meet their objectives.
I want to go back a little bit, because you talked about really educating yourself about these different alternatives and picking something that you feel interested in, which I think is a great driver of wanting to even find out more. Now, I don't think you're saying you become an expert at it, but that at least educating yourself to some degree helps you then pick a team or the actual investment manager. For example, for Kirkland Capital Group, you and I are the primary investment managers for our Kirkland Income Fund. So, you really, when you're buying into our fund, you're saying, "Hey, Chris and Brock, I like what you've laid out. I believe in you guys. We like your background, et cetera, et cetera." And really, that's what you're doing, is you're educating yourself about, "Yep, this is the kind of investment I want, and hey, here's the team that I want on this, and I believe in them." And that usually comes from maybe looking at their background, listening to them, having a chat with them. And I think that's what you're going to want to do no matter what alternative investment you're looking at, right?
Correct. Yeah, you're going to want to. Right now we have tons of conversations with a number of different investors, and everyone is on the hunt for yield, as I was saying currently. But and I think there always will be, given where they are in the life cycle of their in the investment career. But you need to understand that team. Can this team? You've identified the product now. Is this the team, and is the fund in a structure that meets what I need? Do I have the liquidity needs? Do I understand how the fund is built, and are the liquidity needs matching the underlying investment? I mean, there's always little new questions that you got to ask that you would never ask in the traditional world. One of the common failures in alternatives is you have fund managers that mismatch assets and liabilities within the investment they're running. So what that basically means is I'm giving you daily liquidity on an investment that I lock up for a year. Okay, well, that's a problem, because when you come in a time of stress and expect me to give you liquidity, I've actually put you into an investment that I can't possibly meet your liquidity needs. And that would be that mismatch. And they didn't realize that a lot of their excess return that was being offered to them by that manager was being captured through an illiquidity premium that was fairly large. Sometimes they were taking 5-year lockups to obtain returns, yet they were giving investors quarterly redemption capability. So it happens. Just make sure you really understand the managers and what they've built and how they run their business, because that is one of the aspects of alternative investing.
And maybe where some of these alternatives sound like they're actually quite good for a retirement portfolio, because hopefully on a retirement portfolio, you've got a pretty specific end date in mind. You might think, well, I'm going to retire in 10 years or 5 years or 15 years. And then that can be matched with some of these less liquid alternatives.
Correct. I mean, there's a lot of proponents of where I've seen a lot of people using longer term money, which is qualified retirement based funds, to invest in startups, startup companies, which naturally 10 to 12-year time horizons of when that company might have a liquidity event. So that's a better match. And investors that are savvy enough to understand the nature of the underlying investment, what the duration may be, using those funds is very useful. The other aspect is a lot of alternative investments are not, I would say, tax advantaged. They're not structured. The way they trade are not to minimize tax. So let's take a short term, a long short fund that we had described earlier. They might have trading every single month on both the long and short side, capturing those returns, creating short-term gains, and those all flow down to be taxable at the highest tax rate. So a lot of investors that are extremely tax sensitive avoid funds like that. Whereas like a lot of your pensions, endowments, and everything else usually love that type of exposure because, well, they're not a taxable entity. The same with Kirkland Income Fund. We originate bridge loans in commercial real estate. We are generating income. So one of the things that we really want to make sure all of our investors know as well. Listen, you need to talk to your tax counsel. You need to understand how this will impact you, because if you're going to use after-tax money, non-qualified money, there will be a tax impact from these gains. So, I mean, it's there again. It's important, and if you have a rollover IRA or something else, or you have a self-directed 401k or a self-directed IRA, you need to realize that that those are funds that are perfect for many of the different alternatives out there that you might want to add to your portfolio.
One thing I want to touch on before the end here is maybe just talk a little bit about why you established KCG. I'll give a little background here. I was the one who sort of brought this idea of commercial mortgages to you and said, hey, let's look at a fund, knowing you had this deep background of alternatives. But you've approached all the time. You've talked about this over the years about how many people approach you. Hey, I want to do a fund for this, or I want to do a fund for that. So this was definitely not you jumping at whatever opportunity came along. You were being very, very careful with your depth of experience about what you wanted to actually put your work into. So tell me why this sort of qualified for you as an opportunity that you wanted to pursue?
Yeah, I still remember the day when you brought this idea of like, hey, we should do this. And I immediately went into my due diligence mode of, I already had a number of notions from doing my constant research on the world and the nature of what was being created through the Kirkland Income Fund was that ability to provide a consistent yield, which had been a problem long before COVID even hit. COVID just amplified the problem. You basically had a number of investors that were experiencing what they call reinvestment risk, a lot of things maturing or being called that were at higher interest rates, and they're having to reinvest at constantly lower interest rates. And there was a growing demand in that space that I was well aware of. And then when you talk about the life cycle of where people are at, you have an aging population that's coming in and saying, well, I do need that income. I need that monthly income being kicked off. So that was, it's a product that was in demand. I knew it was in demand, and it's something that where, we could create a profile that would capture a consistent yield, but do it in a way to where we could be very risk focused. And what I mean by that is being able to control that risk. And when we walked the nature of what was going to be behind every single loan, we're going to be first lien, full recourse. We're backed by an actual income producing asset. So I just really viewed that as an amazing platform to build in a timely aspect of where I was hearing a number of investors actually ask for that product long before you even mentioned it to me. Now, there's income can be generated in multiple different ways, and there's lots of alternatives that do that. This was one that was very appealing to me because of the risk metrics. Even your younger millennials and younger people that I have a few students that I am mentor to, they would often bring up and talk about, well, I want to capture return, and I've got my actual equity exposure, but what else do I think about? How do I control risk, but capture return? And one of the things that your younger crowd is really interested in is the idea of real estate and the growth of their wealth through real estate, not just my company's stock or my exposure to the S&P 500. They felt comfortable around the tangibility. And I find both spectrums, the older and the younger, are in that space where the older spectrum also likes that tangibility of where, okay, I'm dealing with an alternative investment. I'm working with a manager who's doing bridge financing, but underneath all of it is a physical asset. And it's something that they could get a feel for. And then, one of the things is, for me, having built funds before, really having the ability to come in and build a fund in a nature with the way real estate structured is be very investor focused. And what I really mean by that is really have a fund that allows the kind of transparency that I like to see as an investor and be able to transfer that to our investors. That was another real aspect of, there's certain things that, all alternative investments can't disclose to you because that's kind of a little bit of their secret sauce. But in what this fund could offer, I always tell people the only thing I can't really talk to you too much about is the loan I'm looking at now. I can't dive in and tell you exactly the property and the opportunity of the loan I'm looking at right now to add to the portfolio. But once I've done a loan, I believe in full transparency. I want you to understand exactly what we've done. I want access to that property. You can go look at that property and understand how that's built. And because that's what I would want as an investor. And then your final point to this that really sort of just, was the last nail for me was, hey, we can build this platform and we can also be very borrower centric because the nature of our trade comes from these borrowers. And if we can actually do the right thing in the name of the investor, but also come around and build a platform that can be borrower focused and really be there for those borrowers in a variety of different ways, that was end to end. that was okay. We now have a product that's going to be in demand, not only for the people bringing us the loans, but hopefully for the people also that want to invest in this and gain access to the investment.
And I think what you're saying is the nature of this is that you're able to bring some great returns in a very risk managed way, but you're not doing it by some type of opportunity that might disappear tomorrow, particularly with the long relationships and how things are being built on the borrower side, where we're providing a real service that is going to have those borrowers or borrowers similar to those come back again and again because they like it as well.
Exactly. And that brings another point that just popped into my head was this can all be done without the use of leverage. The one thing that as an investor that I forgot to mention, when you're looking at alternatives, understand how much of that return is generated by the deployment of leverage. Lots of arbitrage strategies, they make very low risk returns, but sometimes they're not very big. And so people deploy a great deal of leverage to make that return worthwhile. And that was the other aspect, is being able to come in and really offer an amazing risk adjusted return for investors that didn't require leverage. And why it's so important to think about leverage is leverage is a two-edged sword. It swings and it can make your returns greater per dollar deployed, but it also can swing and plant right in your forehead. And that's what there again in '08, a lot of people suffered. And, through a lot of the, black swan, left tail events, however you want to clarify, leverage really was that blade that cut pretty hard on a number of investors because it's an operational risk. It can create forced sales. It can cause a lot of problems that really aren't inherent in the risk of the investment, but the manager added a lot of risk to that investment that really is operational in nature. And to a large extent, you'll hear a lot of people say this, that you are taking operational risks many times in the alternative investment space. And you're not always rewarded for the full extent of those operational risks. And to some degree, sometimes leverage is one of those.
Great. We have time for one more question. So I'm going to go for something that's totally unrelated to investments and ask you a more personal question before you end. Life has become a little different here in this pandemic period. But, and of course, whenever you're starting up a new fund and KCG is still relatively new, you probably don't have so much time. So what are things that you really want to do more of, but you don't have time for?
Time and restrictions, I think, is the two issues of it being, hey, don't go anywhere. Plus, also, I'm super busy. One of the biggest things, I've been traveling almost all my life. I look forward to getting back traveling. One of my big hobbies is scuba diving. So I am looking forward to building, this fund, getting it to the point where we've got some real solidarity and we're allowed to fly and go somewhere without spreading some virus in one way or another, hopefully. I guess we're always spreading something, but nothing that's going to kill anybody, hopefully. And get back under the water so I can add to my photo collection of I do a lot of underwater photography. So it'd be nice to have warm sand on my feet and spend some time under the water. That's probably one of the biggest things I'm looking forward to.
Nice. Well, Chris, it's been great chatting about alternative investments, and we hope our listeners and watchers getting some about this and really can help you begin your journey on alternative investings, both the opportunities there for your portfolio, as well as helping you avoid some of the pitfalls by getting yourself educated and really looking deeply into that team that you want to invest with. If you've got questions for us, feel free to set up an appointment with Chris and I. We'd love to talk to you more about KCG or even in general about other alternatives and what we do.
Certainly.
Thanks and have a great day.
Thank you.